The best way to allocate $100,000 may not be what you think. Conventional wisdom tells you to diversify so that you can hedge against risk, but there is something that these people that recite this mantra over and over again are missing out and they are not telling you. You see, there will come a point where diversification becomes a risk in and of itself because the logic actually applies both ways. And some of you may find yourself in the position that I found myself in when I first started investing, where I was overly diversified. So it's true, if you are holding 20 to 30 companies and one company does poorly, your overall portfolio will not be affected that much. However, you actually need to flip the logic around when you think about it, which also means that if one company is successful, the overall positive impact on your portfolio will not be as much either. So now how? What if I told you that the problem was not about a diversified or a concentrated portfolio, but it's a much deeper problem that nobody seems to be addressing? And while this is not personal financial advice, right, this is just my opinion on how I like to manage my own portfolio. And so for me, right, the sweet spot is somewhere between 5 to 7 companies. Companies are not funds. And so how I actually come to this decision, right, I will talk you through my thought process in this video. And so in this recent Straits Times report, 6 in 10 Singaporeans actually think that they will need to work past the retirement age in order to keep up their retirement lifestyle. And majority of those that survey actually think that they need about $1.3 million in order to lead a comfortable retirement. And so in the last video, right, we actually talked about making our first $100,000, and you might be thinking to yourself, wow, I worked so hard to make the first $100,000. Isn't it harder from here on in? But the truth is, after you make your first $100,000, right, compound interest starts to become fun, and that's where you see most of your investment gains. Therefore, at this stage, right, it is very important for you to be able to allocate your $100,000 wisely so that you can balance your stomach for volatility, at the same time achieve your investment returns. You see, getting from $100,000 to $1 million is easy, but it's not simple. What? What do you mean by easy and not simple? You see, it's actually easy because starting from $100,000, the number is big enough such that compound interest starts to work in your favor and starts to work for you. However, it's not simple because the skills and the emotional mastery that you need in order to enjoy the compound interest take some time to work on. But the basic gist of it is that basically you take $10,000 a year and you invest it into a broad market index fund that returns you somewhere between 8 to 10%. And so you'll get to $100,000 in 6 to 10 years. Now, why do I say it actually becomes easier after that? Because all you need to do is keep doing the same thing, stay invested and invest $10,000 a year. And the next thing you know, that in 4 years, you have received your second $100,000. In 3 years thereafter, you receive your third $100,000. In less than 2.5 years, you have gotten your fourth $100,000. And in less than 2 years, you have reached $500,000 by earning your fifth $100,000. So let's take a look at Big Daddy Buffett, because Warren Buffett has a net worth of over $130 billion. Yes, billion, that's with a B. However, one interesting thing to note is that he did not actually become a billionaire until after his 50th birthday. And in fact, 99% of his net worth was actually created after his 50th birthday. And if we were to look at his net worth, we actually realize that at 59 years old, he was worth about $3.9 billion. However, another interesting thing to take note is that between the ages of 83 and 91, he actually averaged about $5 billion every year in profit, which means he made more in 1 year than he did in his first 59 years of life. And that is the power of compound interest. So Warren Buffett was asked how he would invest if he had to start over, and he actually tongue-in-cheek basically said, I would start young and live long. And what he was trying to say is that basically the best time to plant a tree was 10 years ago, but the next best time is today. And what he said here actually leads on to his most important point on how to allocate your $100,000. But more on that in a bit, because this is the point of the video where if you have actually learned something new or got reminded of something that you once forgotten, you have to actually hit the subscribe and like button so that more people can get to know this. And back to our regularly scheduled program. However, before we go any further, we really need to talk about how you can allocate your $100,000. You see, the first way, which Warren Buffett actually also gives his stamp of approval, is to invest in a broad market index fund like the S&P 500. You see, because the S&P 500, right, has 500 companies, and so you are diversified into these 500 companies, and it's basically a relatively safe investment with average returns. However, because the S&P 500 is fully equity, is 100% equity, which means all stocks, basically some people might feel uncomfortable with it, and so the second option is to go with a 2 or 3 fund portfolio where one of the fund is 100% equity and the second fund can be a fixed income fund. This fixed income fund is basically less volatile than the equity fund. However, according to research by PensionCraft, if you look at the last 8 years, funds that are 100% equity tend to outperform portfolios which are a mixture of 2 funds of equity and fixed income. And this is the trade-off you basically have to decide. Is this something you want to take because you cannot tahan the volatility, so you're okay to receive a slightly lower returns over the long run? However, in my personal opinion, actually, if you don't have to do much detailed research, as long as you keep in touch with what's happening in the markets and you actually know what is happening in the market, it is actually okay to go with a 100% equity fund, especially if you are younger in age, and only switch to a 2-fund portfolio and have a fixed income component only as you near your retirement. But the thing is, you see, Warren Buffett actually doesn't recommend this for every single person. When Warren Buffett was asked what he would do if he had to start all over again, right, other than basically making that tongue-in-cheek comment about starting young and living long, he actually gave 2 concrete responses. The first one is actually to invest in smaller companies, and I'm going to let you listen to a clip to his own explanation about why, and we'll talk about that later on.
Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses, or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about.
And in his 1996 shareholder meeting, Buffett actually said it doesn't make sense for this certain kind of investor to diversify their portfolio, and he elaborates on why.
And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that's a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses. I would rather pick 3 businesses from those we own than own a diversified group of 50.
So let's break down what Warren Buffett actually said in these 2 clips. In the first clip, he actually suggested that we consider buying smaller companies. And his rationale is very simple. Because smaller companies have lesser people looking at them, and because of that, there's a higher chance for you to find an undervalued company. I guess it's the same principle, right? As if you're going to buy a house. When you go and buy a house, you know that there are 4 or 5 other people already looking at this house, bidding for this house. Chances are you will not get such a good deal compared to a second house that you enter where you are the only bidder. The chances are in this second house, you'll get a better deal. So when it comes to stocks, it's the same thing. When you hear something is already the next big stock, right? Chances are the profit is already made. And by the time you enter in, by the time you hear it and enter in, right, most of the profit has already been made by other people already. And that's why with a small portfolio, he wouldn't recommend you going after stocks that are basically very popular and very big. And the second point, he basically says that diversification is for the know-nothing investor. So if basically you are a know-nothing investor, then okay lah, go and diversify. But if you actually are a know-something investor, you actually follow the markets, or you basically get someone to manage, a professional that manage your money for you, then they should know the markets. You can basically have a little bit of leeway for you to have a slightly more concentrated portfolio. Because to borrow a term from Peter Lynch, right, diversification can very easily become diversification, where having too many stocks actually negatively affects your returns. One very popular trend that I realized, right, is that people tend to like to have 4 funds in their portfolio. They like to have a US fund, a China fund, a Singapore fund, and either an emerging market or a fixed income fund. So by having 4 funds in the portfolio, right, you basically understand that even if one fund do well and the other 3 do average or below average, you're not really making any money, you know. So although the diversification works in the sense that, yeah, it protects you, you know, if one fund doesn't do well, it doesn't really affect your portfolio. The converse is true, like we mentioned earlier, that if one fund does well, your whole portfolio doesn't really grow as well. That's why diversification can easily become diversification, and that in of itself is a risk to your portfolio. And so what is the magic formula? You see, Warren Buffett, right, when he was 21 years old, he actually only owned 7 stocks, with 65% of his portfolio being in one stock, Geico. Now today he owns a portfolio of more than 40 companies, right? However, the same principle actually applies. He has over 50% of his net worth inside 2 companies, Apple and Bank of America. And so the truth is there is no magic formula, but Buffett did say that to not allocate more money into your best position is basically madness. However, with all that being said, like I mentioned earlier, Buffett also said if you are a know-nothing investor, then it is perfectly fine for you to buy the index fund, but just understand that it's basically giving you average returns with relative safety. However, if you are someone that wants to retire slightly earlier or to basically like coast fire, you have to take on a slightly more active approach to manage your portfolio. So how I would do this, right, if I was in a position that I need to grow my portfolio again, and again I say this is not financial advice, this is just basically purely my opinion. I'll take 30%, split it into 2 parts, 15% each, and allocate it into 2 of the big 7 stocks in the stock market, which means things like Amazon, Google, Microsoft, Tesla, and things like that. I'll just pick any 2 that I like the most and put that money there. And then with the remaining 70%, what I will do is that the 50% of it will end up going into my highest conviction stock. And then after that, the remaining 20% is where I have some flexibility. Now, you can either allocate the full 20% into one stock, which is your second highest conviction stock, or you can use part of the 20% to do that and keep a part of it for alternative investments or even hedging your portfolio using things like options. And for those of you that are retiring soon, right, you can actually allocate your portfolio into those fixed income funds. Otherwise, you can actually choose to basically pick out some Singapore REITs and Singapore banks so you can have some diversification in the form of your dividends. Where is it coming from? Not all your dividends is coming from REITs, that you have a basically split of REITs and banks, and that should be quite safe for you. And at the same time, some people, even though they're retired, they still want to experience a little bit of capital growth, and so you can allocate a very simple 10 to 15% of your portfolio into an index fund like the S&P 500. You see, the truth is you are able to invest in a broad market index fund and retire comfortably in about 30 or so years time. But however, if you are the type that wants to wrestle back some form of autonomy over your life, you want to have some form of control over when and how you retire, the timeline and the terms of your retirement, or maybe it's your goal to achieve FIRE or even coast FIRE, then buying index funds may not be for you, and it's time for you to turn from a know-nothing investor into a know-something investor. And if that is you, you need to be subscribing to this channel immediately, because I will be doing deeper dives in future about how to choose specific stocks and funds that suit your portfolio, that match your goals. You see, the portfolio allocation that we spoke about today is basically suitable for people who are basically aiming for retirement in the future. But if you are someone who is close to retirement, you cannot keep this portfolio and you need to actually basically transition transition your portfolio not only during the year of your retirement, but leading up to that. And if you mismanage the transition, it is very easy for someone to basically lose all the money that they have worked so hard to achieve over all these years. And so basically in this next video, we are going to talk about some of the mistakes that investors make when they start investing.